Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. So tomorrow is shaping up to be a big day for silver price, the gold price, markets in general. Specifically, all eyes will be on Fed Chair Jerome Powell as he delivers his speech at Jackson Hole and perhaps gives us some clues as to where Federal Reserve monetary policy is heading from here. Now let's take a look at what the markets did today, and then we'll think about what Powell might say tomorrow that could have a big impact on the silver price. So first of all, you can see here we're on Yahoo Finance, all of the major markets, all the major indexes in the red today. The S&P 500, the NASDAQ was down over 1%. Russell 2000 was down about 1%, gold down over 1%, and silver down almost 2% today. So what was this all about? What was driving this? Well, seems that, we had a bit of a dead cat bounce in the US dollar index, and I think that this is directly related to why we saw so many assets selling off today. It was more the dollar gaining strength than these assets selling off. But, if we zoom out and look at the chart of the DXY here, it's not looking too good. So, I think this really is just a dead cat bounce in the dollar, likely headed much lower from here. We're going to talk about why, and it has to do with what Jerome Powell will be addressing at Jackson Hole tomorrow. But, just here you can see that there's this trend line which, dates back to July of 2023, and the dollar index touched it once, twice, 3 times, but this time, recently, as gold was breaking out to new record all-time highs, you saw the dollar blow right through this, and I really just don't see much support below this until much, much lower. And, given the fact that the dollar is being debased, they're printing huge amounts of it, it's very likely that DXY is going to head lower from here. And I think today was really a good opportunity to enter a position in silver or in gold, but specifically in silver. It pulled back a little bit more than the other metal. And, none of this is financial advice, but let's just take a look at silver's chart here real quick, because I want to show you the setup. It's starting to look real good for silver from a technical standpoint, and I think maybe, that could give us some idea of what Powell's going to do tomorrow. But, going back to February here, when this big rally started in silver, there was an Elliott wave impulse move higher. So that's the first wave there. The way this works is you get 5 waves. You get the first wave up, corrective wave down, that's wave 2. The next leg of the big impulse, that's wave 3, another retracement, and then the final move higher. And silver completed a textbook Elliott wave impulse move higher starting in February, topping out in May. Then we got a classic ABC correction wave. So starting here, and this is all just based on Elliott wave theory, how market psychology tends to work. And the first wave down is an A, then you get a counter trend rally, the B, and then you get the final wave down, C. So now silver really is set up for another move higher at this point, according to the Elliott wave theory, and that would put us right here. If we start another impulse wave move higher, you get the first leg here. Today's pullback could be the beginning of a second wave, a counter trend decline. Then you would anticipate you'd get the third wave higher, maybe another retracement, and then that's where we get off to new highs. When we break through the previous highs of May, around 32.50 or so. And that is critical level. If we get silver above $33 this year, you're going to get, I think, much higher silver prices than that. That's the critical point we need to break out. And, what could fuel this? Well, the Federal Reserve creating huge amounts of money out of nowhere could certainly fuel the next wave higher in silver. Now, speaking of today's pullback being an entry point, if you're in the market to buy some gold or silver, make sure you check out sdbullion.com. Now, right now, if you're a repeat customer of SD Bullion, you should check your inbox and your email, excuse me, because you might have a VIP offer sitting in there where you can get junk silver at 99 cents over spot. So a very low premium, That's a deal that they send out to recurring customers. So once you shop with SD Bullion, they'll send you some of these deals periodically. And don't worry, though, if you're new, didn't get that in your inbox, you can always go to sdbullion.com/new. And if you're a new customer, you can buy some silver at no markup. You can get their spot silver deal. So make sure you check them out. Now, I do see some familiar faces in the chat here. We got Constitutional Silver, we got James Hutchins, we got Brad B. Hello, Salty Dog. Hello to everybody. Do me a favor. If you're a returning viewer, smash that like button. It's the best thing you can do to support the channel. You can also share this with your friends. And if you're new, hit that subscribe button so you can get more news related to the gold and silver market, more updates on what's going on. And I try to keep you up to date on what's going on in these markets. So coming to some of the economic news today, I want to talk about what drove that rally in the dollar. And we did get a lot of economic data today. We got U.S. existing home sales rising more than expected in July. So it was really only a slightly better month than had been anticipated. But home sales rose 1.3 month over month to a seasonally adjusted rate of 3.95 million units. That was against expectations of 3.93 million units. So, this is one data point that could have caused the dollar to rally slightly. The idea being that maybe the economy is doing a little better than anticipated because more people are buying houses. However, if you look at the data a little bit more closely, you can see that housing sales are declining 2.5% on a year-over-year basis. So perhaps not the extremely positive data point that one might, attribute a increase in the dollar to. I would, again, consider this rally in the dollar just sort of noise, sort of a dead cat bounce. This came out. This was the S&P Global Flash U.S. Composite PMI, and notably, the S&P Global Manufacturing PMI fell from 49.6 in July to 48%. Now, that is worse than expected. And the way these work is anytime this number is below 50, it represents a contraction in the manufacturing sector. So this paints you a pretty good idea of what's actually going on in the economy. We're losing manufacturing jobs. The economy is being hollowed out. The semblance of normalcy that we are enjoying at the moment, this strongest economy on record that we've been hearing about, really is all just based on, all the vast money creation that has taken place over the past decade plus. And the real signs of prosperity in this economy, the fact that we actually, make things, that's on the decline. This signals, according to this report, a deterioration in business conditions within the goods producing sector for a second successive month and the steepest rate of deterioration since December. Also keep in mind that we got that data regarding revisions in jobs. Well, today we got U.S. jobless benefits, and this is kind of being touted as a positive thing because it barely increased. It only increased to 232,000 jobless benefit seekers. Of course, we know all this data is cooked. Again, referring to this, the non-farm payroll data, which was revised down yesterday by 818,000 jobs. That is the number of jobs that were added between March of 2023 and March of 2024. Turns out it's 818,000 less than was actually reported. And look, this number is all just nonsense anyway. I don't know where they pull these numbers out of. The only thing this tells you is that the data can't be relied upon. If you're off by that much, what's the point of even, reporting the data? Why not just, look at some fish entrails or, throw some dice, look at some clay tablets? It's, I don't think it's anything that we need to be looking at, really, the data. But the thing is that the Fed does. The Fed says that they are data dependent. Now, if this piece of data is accurate, that, we added almost 1 million jobs less than we have been told, then you would anticipate tomorrow Fed Powell may wax very dovish because, he's told us in recent interviews, recent speeches, talking points that the Fed is beginning to shift their concern away from inflation and more towards their mandate of full employment. So, for a long time, we were hearing from Powell at every FOMC meeting, the jobs market is strong, so, we can keep rates higher. We don't need to cut. We need to let inflation come down. Well, now, clearly, the jobs market is not as strong as we've been told. So if Powell comes out tomorrow and waxes dovish, you could see markets really catch a bid very fast, because what he's going to do tomorrow is likely give us a sort of a picture of what September will bring in terms of rate cuts. He's almost going to pre-announce the rate cuts. And at this point, markets are guaranteed, basically, or they're guaranteeing that there's going to be cuts in September. If Powell doesn't cut in September, the bottom will fall out of the markets, everything will crash. At this point, the only question is, how much will he cut? Is it going to be 50 basis points? Is it going to be 25 basis points? At the end of the day, though, I don't think ultimately in the long run it will matter, because thank you, Constitutional Stacker, for the super chat, sir. Because look, here's the bottom line. The Fed has to ease because of the massive growing U.S. national debt and the surging interest cost. Among other reasons, right? There's plenty of reasons that you got to cut when you have an economy that is addicted to easy money and you have cut off the spigots. All sorts of crises are brewing. Commercial real estate, regional banks, consumer credit being at record highs, rising defaults on autos, on homes, rising foreclosures, like you name it. They need to get interest rates lower so that people can afford to just service the debt that already exists, let alone the continued massive borrowing that continues to rack up more and more debt. But right now, look at this, $35.25 trillion. We're already a quarter of the way from 35 to $36 trillion. We'll almost certainly hit it this year. When was it that we crossed the $35 trillion line? I think it was like a month ago, wasn't it? It's incredible how much money is continuing to be borrowed. And, look, one thing is for sure, there's a lot of uncertainty around the election right now. And thank you, Constitutional Stacker, sir, for the super chat. He said, oops, I did it again. Well, yeah, I always appreciate the super chat. So anybody who wants to support the channel, thank you very much. I appreciate that. But again, just smash that like button. That's the best thing you can do to support this channel. But so $35.25 trillion, they've got to cut. However, what will Powell say tomorrow? That's going to be what determines the short-term market action. However, I think there's a real case here that he may wax kind of dovish, and if he does, we could see a big pop in the price of silver, gold, the markets in general tomorrow. Now, this was probably the biggest driver of today's sell-off in gold and silver and the increase in the U.S. dollar index, and that was this guy, Kansas City Fed Bank President Jeff Schmid. He had some somewhat hawkish things to say. Now, what is characterized as a hawk today is, maybe different than what it would have been 10 years ago, but this is like considered ultra hawkish, what he said today, and it caused the dollar to rally. He said it bears looking harder at it regarding the unemployment rate. He said, I'm going to let the data show where we lead. I would agree with several of my colleagues that you probably want to act maybe before inflation gets to 2%, but that sustainability to 2, I think, is really important. So what he's saying here is that the Fed needs to wait and see more data before they decide if they are going to cut in September. Now, 818,000 jobs evaporating in the blink of an eye. I think that seems to be data that would tend to make the Fed a little more likely to cut. But this guy thinks that, they need to be more data dependent. Now, this is a great example of how the market just hangs on every word of these central bankers, right? It's not any real price setting mechanism. People even see the skyrocketing debt, right? And certainly that has, in large part, been a contributing factor to why, central banks around the world are buying up gold and driving the price to record highs. But investors in the U.S. Still don't seem to get it, right? I think they look at this number and they think, well, that's fine. You can run up the debt as high as you want, right? The modern monetary theorists told me so. So why would I be worried about it? And that's why, despite the fact that gold is taking out record all-time highs, silver is up significantly since the beginning of the year, retail investors still seem to be somewhat hesitant to get into these markets. But, once the easy money starts being printed, once it becomes clear that inflation is not defeated, right? That trip down to 2% that Schmidt was talking about, I think that we can, kiss that goodbye. That'll never happen. Of course, the reality is with inflation that inflation is going to head a lot higher once the Fed starts printing here, but also that inflation is already far, far above 2% if you calculate it in any way that actually reflects reality on the ground. I mean, they have this CPI methodology. They use hedonics and they substitute things. Basically, like they have a basket of goods that go up, and if steak's in there and it goes up too high, well, they just take that out and we'll say, oh, we'll just take steak out and we'll sub in chicken tenders, right? Something like this. I mean, the way that they calculate this, it's so subjective. They have so much leeway to cook these numbers that, I mean, you really can't trust them at all. And so the Fed claims to be data dependent, but the data that they're relying on is all BS. So, the number you really need to look at, forget the CPI, forget the unemployment, forget the jobs numbers. It's all BS anyway. Look at this number, 35.25 trillion. That's the important number, right? The massive skyrocketing U.S. debt levels. That's the one that will really cause the Federal Reserve to ultimately be forced to cut in a big way, too. I'm not talking about just rate cuts, right? That's like the small potatoes. What they're really going to end up doing here, and it's probably because there'll be World War III or some financial crisis brought on by their mismanagement of the economy. I don't know what it'll be, but there's going to be some event that takes place. Maybe it'll be another pandemic. I mean, I don't know. That's what it was last time, right? They conveniently had a pandemic. Of course, they actually had to start cutting rates before the pandemic kicked in, which is, interesting, right? They started cutting in 2019, and then we miraculously had this pandemic that allowed them to print like $3.5 trillion and buy up a bunch of debt and pump that into the system so they didn't have to, see the whole thing fall apart. Now the can's been kicked down the road. What are we going to get next? I don't know, but they're going to have some excuse to get in here and buy up a bunch of this debt. That is, I think, guaranteed, right? You look at the Fed balance sheet. I don't have it pulled up right now, but the Fed balance sheet is still above $7 trillion. They quote unquote normalizing it through quantitative tightening, but they haven't even begun to touch the original QE from the pandemic, let alone from the great financial crisis or the decade in between when we had nonstop QE. So the name of the game is more money printing is ahead. And I don't know what Powell is going to say tomorrow. I don't have, any crystal ball or any insight into the inner workings of his mind. But I can say that if I was Powell, I would be getting pretty concerned seeing things like the jobs data beginning to actually reflect what's occurring. Not to mention the fact that, the Fed says that they're not politically motivated, but we got the election coming up in November. I think that they tend to favor the incumbent. Powell himself was originally appointed by Trump, but, he was reappointed or kept by Biden and Harris, I guess, by proxy, being in the administration. And, I think there is perhaps a bias on the part of the Fed to try to assist the incumbent. And, one way they could do that is by pumping some easy money into the economy right before the election, which is probably what they're going to do. So it might be time now for Powell to begin telegraphing that. Now, he could get hawkish tomorrow, too. I mean, again, but I think at this point, the evidence seems to point towards him telegraphing some dovish moves from the Federal Reserve moving forward. And that could really light a fire under assets. So, hey, I definitely think that we are in a buy the dip market in both gold and silver. I anticipate silver is going to be heading higher from here. I mean, hey, tomorrow, if Howell comes out, says something hawkish the markets don't like, you get a dip in silver, a further dip. That would also be a good entry point, right? But then again, he could talk and it could rally. But long term, it's clear, even, short to medium term, the Fed is going to be cutting rates soon. And there's very possibly going to be an event that causes them to get in there and intervene in an even bigger way. So anyway, let me know what you think in the comments down below. Now, this is a good question. Mark Cassidy says, how did they assist incumbent Trump? Well, they started cutting rates in 2019. So, I mean, there you go, right? Just look at the chart of federal funds rate. Anyway, thanks for watching, everybody. Stay safe and happy stacking.